My name is Dan Brill. I'm a partner and portfolio manager at SkyBridge. As many of you know, we're big investors in crypto. A big part of our business is a fund of hedge funds business where we're an active allocator to crypto, both passive and active strategies. So we have a good amount of money with a couple of the folks on this stage here today. So Gautam from BH Digital, Brevan Howard, and also Kyle from Multicoin. So we're investors there today. And then, some of the other folks on this panel, we're looking at their funds right now. So we have assembled here a panel of some of the, honestly, some of the best investors in the space. And so we're going to get right to it. I think it's going to be a great discussion of, what active management in crypto means and what alpha in crypto and liquid crypto investing means. And so I'm going to pass it. We'll go in order here where I'll have the panelists introduce themselves and talk a bit about their firms as well. So Kyle, we'll start with you.
Hey everyone, my name is Kyle Samani. I'm a co-founder and managing partner at Multicoin Capital. We manage a few billion in assets today across a hedge fund and a series of venture funds. We will turn 7 years old on October 1st. Currently deploying out of our third venture fund, 18 people, RIA, pretty standard stuff. We're probably most well known for our Solana investment, but we always invest in a bunch of other stuff too.
Hey, I'm Joe McCann, founder, CEO, and CIO of Asymmetric. We're a digital assets investment firm with a couple of hedge fund products as well as 2 early stage venture funds. On the hedge fund side, we're most well known for our liquid alpha fund, where we were notified by Preqin data that we were the top performing hedge fund by performance net of fees for 2023 across all asset classes and geos. On the venture side, we do a lot of deals with Kyle and other folks in the industry and have been very early to Solana as well.
Mike Bucella, managing partner of Neoclassic Capital, probably the newest of the batch up here. We are an early stage venture fund focused globally with a tilt in the Asia markets. So we focus more on Japan, Korea, Singapore. And you're probably wondering why a venture capital firm is on this panel. I previously was a partner at a hedge fund from 2017 to 22 called Block Tower. So that was my experience in the liquid markets, and we kind of integrate some of that philosophy in Neoclassic's venture investments. And I'm also on the board of TerraWolf, one of the sponsoring companies of the program. And Vincent.
Great. My name is Gautam Sharma. I'm the CEO and CIO of Brevan Howard Digital. It's a crypto division within Brevan Howard, which is a 20-year-old asset management platform where we manage $35 billion. At present, we manage about $2.2 billion in crypto, and we have a multi-manager, multi-strategy flagship product for the investors. Our focus is largely on diversification and risk management, where we bring 20 years of TradFi experience on how you run a risk-managed platform and bring that experience onto crypto. We have recently also launched another product called BH Digital Solutions with the focus of helping protocols and foundations on their treasury and risk management around their balance sheet.
Hi, my name is Adam Guren. I'm the founder and CIO of Hunting Hill. We're an asset manager based in New York. We launched our first fund back in 2012 in the TradFi space and got involved in crypto in 2016 through our ETF and closed-end fund arbitrage strategies, looking at some of the exchange products that were backed by Bitcoin and Ethereum. And fast forward to today, we have about $500 million in assets. 80% of that is within our crypto strategies and funds. We run a market neutral fund, a long-only active top 25 by market cap weight index product. And we have a venture strategy as well, which we do some strategic investments within the crypto space and financial services. And excited to be on this panel and grateful for Salt and Kraken for hosting us and look forward to it.
Cool. And then Adam, why don't you take a minute to talk about the new fund that just launched today? So this is just kind of like press overnight. Hunting Hill, in partnership with Kraken, is launching a new product. So I think it's worth taking a minute to talk about.
We're excited to partner with Kraken on a credit fund that we're launching in the next hopefully few weeks. And the product is designed to provide stable and dollars to folks that are looking for some loans or liquidity that hold Bitcoin and Ethereum. So they're BTC and ETH over collateralized loans. And it's a big white space, I think, in the market for A lot of post FTX players that are no longer in the marketplace, providing this type of service to those holders in BTC and ETH. And from the investors' perspective, it's a pretty attractive structure for the loans and provides some decent yield for those that are holding dollars or stable. So it's I think a great time to do it. We could talk about sort of cyclical timing on fund launches and other things here today, but really excited to partner with Kraken on the fund launch, and look forward to getting it off the ground shortly.
Cool. All right. Thank you. Thanks, Adam. So I'm gonna let's start with you, Gautam, and we'll talk about just define. So you oversee a crypto multi-strat fund. So you have PMs, risk takers that work for you that are deploying capital in a variety of different crypto strategies. So I think you are perhaps best positioned to talk about the different sub strategies here when we talk about active crypto management. So how would you bucket the different ways to make money in this space?
Sure. So just to set up the context, right? So if you look at the liquid crypto market, I'm specifically talking about just tokens. Obviously, there's equities as well. Is about $2.1 trillion. Bitcoin is, give or take 55% of it. So roughly $1 trillion worth of spot crypto market out there, which is comprised of 10,000 or even more tokens. And what we have seen is that the top 10 to 20 tokens in the market keep changing every year. That clearly shows that the market is quite early and opportunities come and go. And the rate of change of assets that are well below the first 2030 is likely to be better. And that's how they replace the ones in the top 2030. So clearly, asset selection becomes a very, very important part of active token investing in the space. So the idea would be to find high quality, high conviction projects and then back them with a sizable investment and then see them, go up the ranks in the market cap. So that's kind of one strategy that we follow, which is active token investing. The second is if you look at the derivatives market, which is almost 100 times in size of the spot market with perpetuals, with futures and options, clearly there's a lot of opportunity to create returns and alpha through derivative trading strategies. So one of the examples there is, especially in bull markets, what you see is a lot of leverage comes into the market. Retail is extremely active in the space, and sometimes perpetuals trade at 50 to 100% funding rates versus spot. That creates almost like a market neutral way of making 50 to 60% APY on an annual basis. So that's like another big strategy we focus on. Options are starting to become relevant in the space. What's interesting in crypto is there's a lot of inefficiency and dislocation in the market. There's extreme reflexivity in stuff like Bitcoin and ETH. And what you see is that suddenly when prices go down, volatility collapses, prices collapse. And then that is the opportunity where if you want to make outsized alpha generating returns, especially on Bitcoin, you effectively look for risk managed option based structures where your downside is protected, but then you try to capture as much upside as possible. So we see some of those strategies. And then finally, I would say even systematic opportunities have opened up. I think the infrastructure has gotten far better. So you can actually run medium frequency systematic platform to generate return and alpha on a consistent basis, irrespective of whether you're in a bull market or a bear market.
Perfect. Okay. And so what's really cool about this panel, I think, is that we have folks that are doing all these things that Gautam just talked about here, right? So if you look at Adam's approach, more focused on ARB strategies, and if you look at Joe is more super trading oriented, kind of go anywhere. Mike and Kyle are more focused on asset selection and longer time hold. So Kyle, I'm gonna give it to you next, right? So Kyle's very well known. Multicoin's well known for asset selection, being early in some things that have become very big things over time, but also different than some other crypto funds as well, like willing to accept vol, right? So put on a position, underwrite it, accept the vol, right? And so differentiated strategy for sure, but it all starts with asset selection. So, Kyle, if you could talk a bit about your approach.
Yeah, happy to. Crypto is a interesting new technology, right? And you can pick your interesting new technology of choice. Whether you're going to look at electricity or oil and gas and cars or the internet or silicon or whatever over the last 100 years. And every time some new kind of idea comes around, there's typically, dozens, if not hundreds or thousands of companies that can capitalize on that wave of technology. Up until crypto, the substantial majority of those returns were captured by, or at least the early stage returns were captured by venture capital firms or just the founders of those respective businesses. Post Sarbanes-Oxley, this has gotten actually even more egregious. Stripe today is trading at $75 billion or thereabouts. Private markets, SpaceX trading at $200 billion. Obviously, there's all the headlines about all of these unicorns in Silicon Valley that trade at $1 to $10 billion private valuations that they're 8, 10, 11, 12 years old. Those companies are not accessible to public markets. What's great about crypto is that companies are going public, so to speak, at Series A-ish stage is I'd say the generally correct statement. There are exceptions, but that's certainly the modal case. And it's a really interesting opportunity when you get a chance to invest in liquid Series A stage companies. And so that by definition means there's going to be lots of things where you don't have to talk to the founder, you don't have to have deal flow access, you don't have to have a reputation. You just have to be smart, you have to read, you have to turn over some rocks, you got to do a lot of due diligence, you got to get your hands dirty. Usually that means you got to go buy some products and play with them and figure it out. You got to do reference checks. You have to do a lot of nitty gritty DD work that, if you're a publicly traded hedge fund in equities, you probably wouldn't do. No one's really reference checking the CEO of a publicly traded company before buying the stock, right? So the nature of the DD is pretty qualitatively different. But if you're willing to do that work, you can find stuff. And if you're confident, you go on the screen, you hit the buy button on Coinbase or Binance or whatever, and you can make 10, 20, 50, 100x in 3 to 20 months, depending on what you're looking at. And there's been many of those that have happened in the last 6-7 years in the market. I'd say we generally specialize in kind of trying to do that. We do that on our venture fund, obviously, where we invest before the tokens launch. And then we also do that in our hedge fund vehicles as well when the tokens have a liquid price.
Cool. So Adam, why don't you talk about some ARB strategies in the space, right? So way different than pure asset selection and long.
Yeah, so from our perspective, we come from the market neutral side of things. So we're looking for what we would consider almost pure alpha. And some of the kind of key components for us is risk management and understanding how to manage market structure with leverage. So if we're looking for an opportunity market neutral that would occur, typically most of the stress or sort of most of the best opportunities we've ever seen happen near the tops of markets or near the bottoms of markets. So when we're talking about, alpha generation, how does that happen? Generally speaking, it's either in cyclical type of strategies or something like, what Kyle and Joe do, where they're sort of picking the right names and right coins. And so for us, when we're looking at cycles and different ARB strategies, they typically happen, like I said, on the bottoms and tops. So at the moment, a lot of the funding trades, one that kind of Gautam got into, which is on the perp side and the funding trades, those look pretty attractive. Those trades called manifest itself similarly to credit. So when there's just not enough dollars or not enough stable in the system, those perp trades start to expand. Credit looks more interesting. And so that's where we start to dip our toe. When we're starting to see called bull market signals in the ARB space, we just let the market come to us and take advantage of what we can in what we see in sort of different funding trades, different rate trades. On the sort of flip side of things, what we saw in 2022 and 2023, which was more on the distress side, we saw a lot of fire sales in assets that either FTX had owned or just other institutions that had gone bankrupt. And so when we're looking at different ARB strategies, we're looking at those distressed purchases and looking to hedge them in some form or fashion that we can do with proper risk management, again, with potentially even some leverage. And so we saw a lot of those trades in 2022, 2023, where we were buying closed-end funds and sort of other assets that were pretty attractive, specifically with the GBTC trade at 45% discount, now trading at parity as an ETF. So, we were kind of high level looking at those cyclical type of trades and trying to capture them through the ARB strategies that we.
And how, when you think about where the market is today, Adam, right? And you do have more institutions getting involved, but you do you see ARB opportunities in this market that if you've been a traditional market participant for a long time, you kind of scratch, you're that really exists, right? And but it does, right? And so I think you can sketch out some of these trades and they're relatively simple, right? You just need to have the pipes connected to be able to do them. But like, how long do you think that exists? That's 2 years? That's 5 years?
Yeah, I mean, one thing I really love about being in the market neutral space is it's constant innovation. So we were making the assumptions that these trades will not be around for 6 months or 9 months or 12 months. And so we are constantly looking for new ideas and new strategies within the space. So if we're looking at the funding trades, for example, yes, a lot of it has to do with market structure. If JP Morgan and Morgan Stanley and Goldman Sachs all walked in today and we're going to start doing funding trades in the same way that we do, it would disappear. It would go down to risk-free plus maybe 100 basis points. That's not the case right now, and there's a lot of reasons for that. There's custody reasons. There's just sort of bank solution problems that the U.S. can face. And so, yes, players, up here on the stage can take advantage or participate in those markets where the banks may not. How long will it last? Maybe until November 9th. I'm not sure. But we're constantly innovating and looking for new ideas even beyond those.
Cool. All right, so Joe, I'm going to go to you next, right? So Joe is a bit unique in this panel where he's definitely ARB strategies are obviously trading oriented, right? You're moving your book around a lot, but they're not, generally speaking, a manager there is trying to not be directional. They're trying to capture some inefficiency, where Joe is very trading oriented. He'll do ARB trades, but he'll also do big directional trades in a trading oriented way, right? So he's not in love with the position. So talk a bit about that approach. Definitely unique broadly in markets nowadays, right? There are much fewer just trading oriented managers. So talk a bit about your approach.
Sure. So, I've been a technologist and a trader for about 24 years now. That provides me a pretty unique lens into identifying trading opportunities in crypto because crypto is programmable money. It's software. And so my trading partner actually managed billions of dollars at Brevan Howard, global macro, cross asset, cross geo. And we have a really unique lens from a macro perspective as how it informs our view for the trades that we actually put on. And so at Asymmetric, we trade anything that moves. This could be from, things like Bitcoin, of course, to things like meme coins, which I think in some cases, certainly in the more traditional financial space, meme coins are likely laughed at. It's generated huge returns for folks who've been early enough to be able to express those trades. And in fact, if you look at like the last bull market cycle, Dogecoin was one of the top performing assets out there relative versus, loads of other kind of VC touted layer twos or the Ethereum killers or whatever you want to call it. So at Asymmetric, we also have a really kind of complex and robust derivatives options book. I think Gautam was alluding to this earlier. The mispricings in the options markets in crypto are unbelievable, and you have myriad dealers that are out there where you can actually cross against them if you needed to. But you find in crypto, if you understand how to trade options and derivatives, enormous opportunities. So for example, when Bitcoin, traded up towards 73,000 back in Q1, you had volatility through the roof. In that scenario, you could actually short strangles and capture an enormous amount of premium. And if you were to get called away, you were getting called away 15 to 18% higher. If you were buying it back, it was 15 to 18% lower. These opportunities arise all the time in crypto. The difference is most folks in crypto don't tend to follow these types of sophisticated trading strategies. So at Asymmetric, one of the things that we really focus on is how do we look for kind of technology and culture clashing with the tokenization of these types of technologies and being able to express that trade in the most optimal way. This could be through just buying the spot tokens. For example, there's a meme coin that represents Kamala Harris. We look at that as kind of like a digital option. Digital option means it either happens or it doesn't. These things are very illiquid, but you could take a small percentage of your fund's AUM, put it into that, and now you have the expression of what a digital option would be, whereas digital options don't currently exist in crypto. So I think on net, we look for any opportunity to generate returns for our LPs, right? We don't have some sort of, elitist view on the assets that we actually hold. We want to generate returns for our LPs. And if we find those opportunities and they work for us and are within our risk constraints, we ended up with the kind of returns that we end up with.
Cool. Mike, let's go to you. So you have done both, right? So Block Tower was one of the early investors in, liquid crypto markets. Mike was one of the first guys I ever talked to crypto about back in, probably 2015, 2016. But your new firm has a narrow focus, right, on much earlier stage investing. So talk a bit about that and some of the opportunities that you see at that stage.
Yeah. So, alpha is just a function of mispriced risk. And I think that comes down to a few different factors. So I think it's accessibility of market really is the primary key. And when I was leaving Goldman in 2017, Block Tower was getting started up, it was hard to access the market. And there was a very alpha rich in terms of asymmetry of markets and information. So that was a very attractive, probably the most attractive thing I'd ever come across. And that was why I decided to bet my career in it. I think a few others here decided to do that as well. So that was, at that point in time, made absolute sense to me. And then over time, the market evolves, it matures. You have these new things, you have perps that develop, and then all of a sudden, market neutral makes a lot of sense for a different risk profile. But then the market misprices the risk of the exchanges in which you're trading those on, and all of a sudden, 20%, basis trades are not really that great of a return at that point in time. A lot of this, again, the industry matures, things get flushed out, FTX, some of the lending platforms, and we move forward. I think the way that I think about the market now is very similar to how I thought about it back then, which is what are hard markets to access. And so for what we focus on is, again, hard to access markets because those are generally mispriced. So Japan, for example, kind of a narrow market from a consumption standpoint, but an IP powerhouse, and then distributes IP throughout the world. And I think it's very hard to do business there. And I am clearly not Japanese. But my business partner has spent a lot of time working there. He grew up for part of his life there. And so being able to tackle engaging that market, we think will generate long-term outperformance in early stage investments. And I think the other part to think about is we're talking about liquid tokens. The private and the public market meld together in crypto and they merge very quickly. There's no gatekeepers, there's no investment banks, there's exchange listings and market makers. And that's basically your gateway to liquidity and what Kyle mentioned earlier, which is you get the ability to invest in a liquid format in Series A, Series B, Series C companies versus having to go trade a $100 billion, $150 billion secondary in SpaceX on Forge, for example. My friends at there gave them a plug. So I think for us, and I think for anybody, and even early on at BT, our best investments, a lot of the alpha was generated through early stage token investments where we took a very, very strong view on an asset, invested at what was very attractive valuations. We worked, and the reason it was attractive was because that theme, that sector, that area of the market was underfollowed. And then it becomes more followed. I mean, you talk about the Solana trade or Solana investment you guys have made. High throughput blockchain was not really a thing for a period of time. We were talking Bitcoin versus Ethereum at that point in time. And so being able to go early, hold through, and I think we were talking about this in our prep, sitting on your hands is very important, both from a tax standpoint, but also just from a return standpoint. I think the velocity of the way things move in crypto, you have this almost need to sort of trade out of positions. I think you learn in time, spending enough time in this industry, that sitting on your hands is a alpha accretive activity.
Yeah. I mean, he was actually asking me backstage, it's like, so do you trade every single day? I'm like, I haven't made a trade in like 10 days because there's nothing to do.
Exactly.
There's a really good Peter Thiel quote, which is, whenever you see a really aggressive step up in valuation, whether it's from A to B, B to C, C to D, whatever, and on the surface, if you're an outsider and you look at the step up in valuation and you're like, wow, that was crazy. His quote is basically, the more aggressive the step up the valuation, the more underpriced the asset. And the reason that statement has some truth to it is typically that means whoever's buying, really sees network effects or some compounding or whatever that's really, really strong. And if you take that and apply it to liquid markets, where now you've got Series A, Series B, Series C stage companies that are public, then that effect by definition will be heightened, because now it's not just did Andreessen or Sequoia or Lightspeed or whoever put the term sheet out, or they had a relationship with the founder or whatever to get the deal done at $2 billion instead of $1 billion. Now it's a million, 10, 50 million people on the internet all over the world reading, all coming to the same conclusion, all seeing the same tweets and reading the same articles, and all going and hitting the buy button all in a matter of, days or maybe a few weeks. And so when assets get re-rated in crypto, in liquid markets, it really happens far faster. Like there is no equivalent phenomena in traditional markets. And it happens for kind of this core reason.
It's an awesome point, right? And like if you think about, there are different philosophies in markets, right? But like another way to say what Kyle is saying, right? And like because crypto is a younger and still developing market, right? Like, can you buy new highs, right? Like, are you comfortable with that, right? Like some people sell new highs, some people buy new highs, right? Like there is a school of professional investors who say like, I'm comfortable to buy a new high, right? Because that means there's new information, right? And it could be anything, right? So like there's a whole group of investors out there with Bitcoin at all-time high, right? It's like, that's a signal to buy more Bitcoin, right? Because it's going to go even higher, right? There's a group of investors who maybe have a different approach, who say, no, I'm going to trim or I'm going to right? But this market is still so young, right? So that approach of like, hey, the market's telling you something as you have these step ups. So I think Gautam looks like that's something.
What's really interesting in this conversation is that in all these strategies, there is an inherent asymmetry, right? If you think about it, right? So whether it's like buying a project which is liquid at 100 million valuation, but for all practical purposes, it's a venture investment, but tends to have a liquid market, you might get a 10, 20, 100x, as Kai mentioned, there's clear asymmetry there. Or if it's like just the option structures that we talked about, where again, structurally there's asymmetry. I would say even market neutral strategies, really, if you think about it, you're literally taking very low risk. You're probably just taking counterparty risk. If you manage it well, you're effectively talking about APYs of 50 to 70%. So structurally, there is asymmetry opportunities in crypto across strategies. And I think it's not completely a new era that we are in, because if you go back in history, you used to be able to buy the Amazons of the world, the Googles of the world at much lower valuations when private equity wasn't a thing. But now, as Kyle mentioned, if you are to buy something like a SpaceX, you have to, as a retail investor, wait for it to get to 200 billion valuation and then list. So your asymmetry is gone. So I think that's the opportunity that this space presents, that if you're early, across these strategies, if you manage it well, there's a lot of asymmetry. So the risk reward is very attractive from that perspective.
And this is why I named my company Asymmetric. Thanks, guys.
So let's have a bit of fun. So everybody here has been through, and survived and come out of it and, thrived, on the back of multiple crypto cycles now, right? So this last cycle obviously produced some unique opportunity, right? So like in traditional hedge fund land, you'd say like special sits type trades, right? That came about. So we were talking about a couple during the prep panel. Kyle, I know you mentioned a SOL trade you did. If there's anything else you guys would like to highlight, just kind of unique opportunities that were created by the dislocation in markets, right? And that could be meaning you have a special sit opportunity usually created by a non-economic seller or a forced seller or just an extreme supply-demand disruption in markets.
I think I'll probably highlight one which was very interesting for us when we were looking at it. So back in September last year, there was a lot of discussion on Twitter around how, the FTX Solana holdings will be sold and dumped in the market. And then Twitter tends to kind of front run any of that. And then suddenly you saw like SOL getting crushed in the market. But if you just take a step back and ask yourself, if players involved like Galaxy are there, will they go and dump this much amount of crypto assets on the market? Will there ever be a market to absorb that? It's not possible. There's going to be block trades. There's going to be a structured method to do this. But the market was just overreacting to it, right? So that was a clear dislocation. And all we did was that time just like have conviction in SOL, for instance, and then just buy at that price, right? So there are these pockets of dislocation that we see come pretty often in the market in both liquid assets, but also on trading and derivatives.
Yeah, I mean, to add a little bit to what Gautam's describing, so you all likely heard of the FTX locked SOL estate sales. We looked at it a bunch. A lot of folks raised a lot of money for these types of vehicles that would ultimately end up buying locked SOL. But the kind of second order effect is a lot of these folks, say they bought, $100 million worth of locked SOL. they'd immediately hedge that against a perp contract because they got it at a discount and capture the basis. So they were doing whatever, 50, 60 to 100% annualized. The key though, and I think this is lost in the conversation around, say, the locked sold trade, is that in order to short the perp or the derivatives contract against your locked SOL, well, you can't, because most dealers don't take locked SOL as collateral. So all of these folks that are shorting to capture the basis are having to post cash, which means they're actually naked short, which is setting up for an enormous short squeeze potential. These are the things that I think Gautam is talking about, that like the market reacts to certain aspects, but doesn't take a kind of second order view of what is actually happening. So I'm not suggesting that we're going to have an enormous short squeeze in Solana, but it's also probabilistically available to us. And so that's the type of stuff that we look to identify, like how can we structure options contracts that go out to the bullet payment that happens in March of 2025 when a lot of this SOL unlocks, such that if there is, a squeeze that could come up to that point because these folks have to post more collateral or cash as collateral, where does Solana ultimately go? So I just want to underscore the point that Gautam's making, that what you end up seeing as like the actual headline, if you do a bit more digging, there's way more alpha to be generated from doing that research.
There was a lot of juice in the FTX estate. I mean, that was just, it was, and something that it took people that had been in the market for a number of years to be positioned and take a view on which assets had value and which you could basically disregard. And again, it's all of that's the nice part about multi-strat and what I think a lot of guys here do, which is everything informs everything else, right? Like you could see, some sort of information from a basis trade blowing out that would have an impact on your spot trading strategy.
Exactly.
And you can, as a, investor in an application or a certain sector, say, you know what, we're seeing a lot of developers building on this blockchain versus that blockchain. That's fairly interesting. Why don't we get long this asset? We've done that, did that over the years. And I think on the special sit side, retail giveth and retail taketh away, right? In the world of the long tail of crypto assets, it is still primarily a retail and whale industry. And so in raging bull markets, things get nonsensical. And right, buying tops becomes harder and harder and harder. And ultimately selling a top or selling near the top, if the liquidity is gifted to you, which again, liquidity is everything in the world of investing, then you should be taking if and when you can, right? Because if you have a 500, 1000x, the likelihood that you can actually sell that out when the market is not providing liquidity is next to zero. So I think, in the world of volatile markets, you can get on a super distressed cycle, you can get a liquid asset with a very developed product trading at a massive discount to what the private markets are offering you. And so as a venture capitalist in crypto, you need to be very, very cognizant of what's happening in public markets and sometimes take the opportunity to do so. And I think most of us who have venture funds have a flexible enough mandate that can allow you to invest in liquid assets on some occasion. And so you can see things trading, you're looking at 5 different projects in a particular market sector, and you've got this one glaring you in the face that's in the liquid market, right? You obviously take position there. So that's another interesting part of our market that is not available in traditional assets.
Kyle, you want to add anything? Adam?
I mean, I would just maybe add for the folks sitting up here that one advantage that we tend to have is balance sheet. So when there's complexity risk that we're underwriting, whether it's an FTX estate sale or digging into a kind of an early stage company, yes, there's retail players. There are folks that do it in family office structures. And sometimes balance sheet is what really matters. And if there are block trades or other complexity risks that we're underwriting, we enjoy the ability to flex the balance sheet up in sort of multiple different ways, which gives us the edge or alpha in that case.
Cool. So this kind of, anybody who wants to take it, right? How have you seen from an institutional investor perspective, right? Like, how have you seen, you guys have all been doing this a while, right? So the very early investors in your funds were folks that were like super, open-minded, right? And were willing to take unique risks, right? Going back a long time. But now the market's clearly changed, right? And you have, institutional investors who are looking to integrate digital assets into their strategic asset allocation, right? And so the conversation has changed for sure. But it seems to me like we're big investors in the space, but it still feels like, it's early innings, like super early innings, right? So, whoever wants to comment on that, like how are the conversations changed? Where do you think we are?
Yeah, I'll jump in, mostly because I have a hedge fund that I don't think a lot of institutions would actually want to invest in. No, look, we spoke with institutions. We were fundraising originally in 2022, and they were all terrified for obvious reasons. Primarily at Asymmetric, our LP base are high net worth, family offices, and fund of funds. The challenge, I think, someone like Multicoin has an incredible track record in history where they can raise from institutional investors.
A little harder than you think.
Yeah, I mean, exactly. So if it's hard for Kyle, you could imagine what it's like for a newer fund manager like myself at Asymmetric. So we just fish where the fish are. I mean, folks that are high net worth, family offices, and particularly fund of funds, are more comfortable with some allocation of their estate or wealth into a crypto fund, especially if you can provide, I think, a level of sophisticated risk management to the extent that, hey, you're not going to blow up for XYZ reason. You've got enough experience. You've got a decent track record. Here's your kind of resume. That has served us really well, but it's also incredibly market dependent, right? So after Q1 this year, when Bitcoin hit a new all-time high, we were very blessed to have a number of new LPs enter the fund. Since then, it's kind of dried out, right? It's like the negative wealth effect genuinely affects the folks that we're actually raising money from. On the flip side, the institutions, these things take, I mean, Kyle could probably opine on this for a long time, but forever to get closed. And on the hedge fund side, it just becomes very, very challenging to get folks comfortable from either an ops or due diligence perspective because the asset space is so nascent.
Yeah, you go ahead.
Yeah, my co-founder Tushar did a podcast just a few weeks ago with an allocator named Ray Hindi, who runs probably one of the oldest crypto-focused fund of funds out there called L1 Digital. He's out of Switzerland. It's with the Blockworks guys. It's really good. But the basic thing they kind of talk about is that the most under-allocated part of crypto markets today, by a pretty large margin, is liquid long crypto. And so whether you go buy Bitcoin, ETH, SOL yourself, or whether you invest with me or Joe or Gautam or whoever, it doesn't really matter. Like, we're very clearly the most under-allocated part of the market, and has definitely the best risk-adjusted opportunity set today. The reason that's the case is actually structural. If you look at almost every major institution around the world, whether it's pension, life insurance, endowment, whatever, in basically 100% of those institutions we've spoken to, there's usually one or two crypto guys who, like, someone works there, likes crypto, and that becomes the crypto guy or crypto gal who works there. Maybe that person was on the venture team prior, maybe they were not, but what ends up happening is that person ends up getting slotted into the venture team at whatever institution. And the venture teams want closed-ended vehicles, limited recycling provisions, 10-year fund life, quarterly marks, etc. And so they just end up looking at venture funds. And so venture is over-allocated and liquid long crypto is under-allocated for this reason. This has been true for quite some time. It was painfully obvious a year ago. I still think is fairly obvious today. But you end up, if you just understand how capital allocation works across big institutions, it's actually very clear.
It's a great point.
Gus? I would just jump in on the institutional due diligence process. I do agree it takes a long time, and we've had processes that have taken 18 months, and then we've had an investor come in. And I think the success that we've had is multiple fold. So we have a track record. The hedge funds that we've run have been around since 2012. They've been trading for 20 years, managing risk and market neutral, which is, I think, a unique space because there's leverage applied. There's sort of understanding of market structure. We're SEC registered. We have a pretty experienced team. Ernst & Young is our auditor. All of those things that check boxes, not just on a risk and pricing perspective, but also operational due diligence and risk and controls kind of internally. So I think that's an important step. I think the industry has matured in a lot of ways, and some of the called silver linings on the back of FTX is the investor base has gotten more sophisticated, wants those things, and those things are also offered by managers now that maybe didn't used to be 4 or 5 years ago. So we found some success with some institutions coming in. I do think it takes a long time, and that's pretty natural. Maybe Brevan has a little bit easier given their 20-year track record.
And those are good things. I mean, having the name like that is a good, I think, generally for the space, and getting pensions and endowments, which we're starting to see actually put money to work in the last 6 months is interesting and important. And they're doing due diligence even in the U.S. ahead of the election. Whether or not who wins almost doesn't matter in that case. They're doing the work to understand it before it happens.
Basically, our data rooms are a lot more dense than they.
All right, so our time is up here. Thank you, gentlemen, and thank you all for attending, and enjoy the rest of the event, and get out there and enjoy Jackson Hole too. So.